My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you a little money. My job, not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Why did the averages roar after the Fed's triple rate hike today? Dow gaining 436 points, the S&P surging 2.62%, and the Nasdaq skyrocketing 4.06%. 2 words: data-centric. When Fed Chief Jay Powell spoke that phrase, it meant the Fed isn't gonna kill us. Normally, 2 back-to-back 75 basis point rate hikes would be the kiss of death to the stock market. But Jay said it's now important to watch the data after these hikes. If the data stays too hot, of course, he'll keep tightening. But otherwise, he wants to sit and watch, because at this point, we've gotten enough weak data to justify some patience. And he's officially now ahead, not behind the curve. The Fed doesn't meet again until September. Hey, they got August off. So the bulls took this as a moment to frolic. And it might be a little bit longer moment than most of you expect. Of course, these Fed day spikes do not tend to last, though. Hey, you know the last 2 Wednesday rallies in response to Fed rate hikes have yielded nasty Thursday sell. You know, after the conversation turned quickly into, okay, how big will the next rate hike be? But there really is some softening in the economy this time, and there really is no August Fed meeting. So the odds favor buying, not selling stocks into the next moment of weakness. You know, I don't like to buy on spikes like this one that we had today. But the dialogue will now switch from how big will the next hike be to will there even be a next hike? And if so, it's certainly promised to be smaller than the last 2. Look, I've long been a Jay Powell fan. You know that. I'm on his side. Now, what did I want? I wasn't too critical. I wanted him to do a couple of 100 basis point hikes. But I'll take 275s and then wait. That's pretty perfect. Hence the rally. More important, we didn't get what I was most worried about. The market would have been crushed if Powell said the economy remains red hot, nothing's really working, so we may need an emergency rate hike next month to stamp out inflation immediately. Don't take that off the table. It could always happen, but it doesn't sound like it will. All right, we're being a little theoretical, and you know I don't like theories. What I do like is that in today's session, a lot of bears were caught, trapped, filleted, and put on the wall. Kind of like one of those exhibits at the Museum of Natural History, and that left the bulls free to do some trampling. The bears were caught looking the wrong way because they were extrapolating negatives. And look, extrapolation, it can be a fine way to make money, but it can also lead you astray. Lately, I've seen a lot of extrapolations done wrong and very little done right. Think of it like this. Not long ago, a distinctly second-rate company, Snap, reported a simply horrendous quarter, calling out tremendous weakness in ad spending. So what happens? Anything remotely related to advertising on the web gets absolutely crushed. It's a charnel house. After Snap, you think it's impossible that anything good can come from an internet stock. And that's when the short sellers come out of the woodwork, betting against anything that's even remotely similar. Alphabet, the parent company of Google, starts getting leaned on. Oh, the shorts, what they think it's easy money. But then Alphabet reports a terrific quarter last night, because this is a much better company than Snap, with a much higher return on investment for its advertisers. Plus, Alphabet's always first party, meaning you're going right to it, so they don't have anyone blocking their data tracking. And Google tells its clients exactly how people got to their site, so you know who is going. You get a return on investment. With other kinds of advertising, after Apple's privacy changes last year, you have no idea if it's working. With Google, you can actually figure out what your ad spending is getting, so you've got every incentive to spend more. With Snap, it's Rice Krispies. Snap, crackle, pop. Next thing you know, Alphabet's up nearly 8% today in response to that excellent quarter. Now, Meta, which reported this very evening, did not have a good quarter and did not have a good guide. And yes, indeed, the long knives are out for this stock. But remember, it's down more than 50% coming into the quarter. And by the way, it was also up 10 points just this session. So it's going to give something back. Was it horrendous? I'm putting it in the not horrendous camp. Did I want it? My Chapel Trust owns it. I'm putting it once again in the, yeah, we own it. We got a low basis on it. Here's what I expect. Here's what I say. It's not worth selling. I mean, it's going to give you a little give back after that rally of 10. I think it should be expected. Or how about the extrapolation we've seen with the stock of Spotify? Ooh, that's been a nasty one, hasn't it? This podcast and music streaming company has been endlessly leaned on by the shorts. It didn't matter that we all loved the company, didn't we? Somehow it got tagged as being a stay-at-home play. And that, my friends, is the kiss of death in this market. After all, Spotify is a subscription service like Netflix with growth that seems to have peaked. Also like Netflix, right? Aren't they the same? Wrong.
All aboard!
Spotify just crushed it with amazing monthly user growth that shocked Wall Street. Extrapolating from Netflix just crushed you! Absolutely, it shredded you, frankly. Spotify jumped more than 12% today. All right, how about Chipotle? Oh, man, I mean, like, we ordered on Fridays, by the way. I don't know if we can get it down here. We were up in Englewood Cliffs. I don't know if they deliver. Do they deliver Chipotle down here? We don't know if they deliver it. All right, but anyway, that's probably a little bit beside the point. Chipotle is probably a dangerous stock, right? I mean, it's higher priced food, hard to keep help, can't raise price, just like all the other fast food companies. The short thought that this one was just like shooting fish in a barrel, which it's actually done, by the way. It is not nearly as much fun as trying to land one in a pond. But today they got shot because Chipotle delivered a blowout quarter last night, allowing its stock to jump nearly 15% today. Hey, why not? The price increases have been met with no resistance. Retention of employees. Look, if you know how to manage the place, they aren't going to leave. They stay and stay and stay. And you know what? Can I also add that the food is very good? Sure, Chipotle's got, they've got some things that are wrong. They have a more affluent clientele, so you can't necessarily say that it was because everybody's still going. It's really the wealthier. But so what? Isn't that something the sellers should have thought of before they started shorting the stock? I mean, Chipotle's always had a higher price. And don't even get me started on the semiconductor stocks. NVIDIA, AMD, Marvell Tech, of which Chapel Trust owns all three. Now, each of them has had an Achilles heel that's really been hurting lately. NVIDIA makes cards for cryptocurrency mining. When everyone's given up on crypto, it's kind of like, looks like a sophisticated pump and dump scheme, doesn't it? It also got exposure to gaming. Oh, my good, gaming. Well, yeah, kiss it down. Hey, AMD has the same problems. It's also got personal computer exposure, a business that people are really worried about. Marvell Tech has 5G. Ooh, scary. Oh, I have a scary button. No one wants that anymore. But then Google and Microsoft start talking about how much computing power their cloud businesses need, and boom, it's up and away. Now, it doesn't hurt that the Senate finally passed the CHIPS Act today, a highly necessary piece of legislation that also happens to be very beneficial to the semiconductor industry. And you know we're a bunch of hacks. I'm going to go tell my staff to get us some chocolate chips. I prefer Chips Ahoy, just so you know, in case you want to send them to me. Finally, what could be worse than a telco after AT&T and Verizon both reported, oh, my God, horrendous numbers? Well, at least they got dividends, right? And just imagine what will happen to the dividend-free T-Mobile when it reports. Who wants that? Well, once again, the shorts got it wrong because T-Mobile absolutely blew away the numbers. How? Simple. They're taking share from AT&T and Verizon. Sure, it's a telco, but it's none of the baggage of the other guys. AT&T complained that its customers are paying their bills late, costing them hundreds of millions of dollars. It's a billion. Verizon has to spend $10.75 billion on dividends. But T-Mobile doesn't have those obligations. It can plow its cash back into providing service. Plus, unlike the other two guys, T-Mobile doesn't have to raise prices. Just imagine how many customers they'll poach next quarter. Oh, by the way, I spoke to Mike Siebert. It was over here. You see, look at all these crazy people. What do they do? It's like a food stamp. I was on food stamps. That's my staff. I just thought I had to do that. It's kind of just got a kick out of it. But anyway, where were we? Oh, yeah. Absolutely. Now we know the Fed almost certainly isn't done with its hiking, right? We know that inflation's still too hot. As I said earlier, these rallies tend not to last. The market usually reverts to case-by-case stock picking, though, and that's terrific. That's what we do on Mad Money. We now know that Powell doesn't want to cause a recession and doesn't think he needs to cause a recession. So there's an advantage for the bulls here, especially because he's caught up to the curve and maybe past it. But listen, when a company misses and then guides down, don't expect it to rally, because that's not how you hook the bulls. Bottom line, the Fed looks to be out of the way until the next meeting in September. Maybe they're ahead of the game even, but the data's starting to go their way. So let's go case by case. And I bet that with some softer background, the best earnings will be rewarded with higher stock prices, while the declines and everything else, at last, could be more muted. I want to take calls. Let's go to John in Washington. John.
Hey, Jim, how you doing?
I'm doing well, John. How about you?
Okay. I'm down about 10% in Diamondback Energy. With earnings coming up soon, I need to know, should I buy some or sell some or just wait it out? What do you think?
Well, remember, Fang's got, Diamondback Energy, has got a very, very good yield. It's an excellent company. Travis Stice is a terrific CEO. My inclination is to buy it, but it was up 5 points today, and I tend not to want people to buy something up 5. But I would not sell Fang, the real, this is the replacement Fang, because of that yield and because of that management. I think they're in very, very good shape. I think that's all the questions we can take. I love that. I'm saying hi to my staff again because they've done an incredibly good job, and I'm in an incredibly good mood. But that's because I'm seeing Jackson Brown tonight. It looks like the Fed is out of the way until the next meeting. I bet with a softer background, the best earnings will be rewarded with higher stock prices. On Mad tonight, from the health of the consumer to the state of the stock market, Bank of America has its finger on the pulse of a host of topics, and I'm going straight to the source for answers with the company's CEO. Then Ford, holy cow! Before after the close, I'm going to take a closer look at the results, which look darn good, with the CEO. And Shopify announced plans yesterday to lay off 10% of its employees. We got to figure out what the heck is going on there for e-commerce and the company itself. I'm going to discuss with the company's top brands. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.